Many traders mark a support line, wait for the price to drop into that zone, and immediately hit the buy button. Entering a trade the second a line is touched is like driving a car while ignoring the dashboard. You are missing the very gauges designed to tell you how the engine is actually performing. To stop guessing, you need a way to verify market intent. Today, we are building a 4-step checklist to read momentum and confirm your entries using the language of candlesticks. Before we start step 1, you must have your support and resistance zones already drawn on your chart, validated by at least 3 previous price touches. Identifying a key zone tells you where the market might turn, but only the candlesticks can tell you when the buyers are actually taking control. Step 1 is measuring momentum. Look at this comparison. The massive, full-body block on the left shows high momentum, while the compressed block on the right shows low momentum. A large body indicates an influx of orders, while a shrinking body shows participants leaving the market. Notice the sequence of red candles approaching the support line on this 4-hour chart. They get progressively smaller, dropping from 50% down to 10%. This shrinking pattern is called exhaustion. It shows selling pressure is physically running out of power. While exhaustion doesn't mean you should buy immediately, it signals that the market is now positioned for a potential reversal. Step 2 is the influx trigger. This shape is a hammer. Its defining feature is a long bottom wick reaching into the support zone. That wick records a failed attempt to break lower. Sellers pushed the price down, but were forcefully rejected by a sudden surge of buying orders. You might also see a massive full-body engulfing candle. Both shapes serve the same purpose, providing visual evidence that buyers have entered the zone. However, beware of clusters. This chart shows 3 consecutive candles with long wicks at the same level, signaling a buildup of stop-loss orders just below. Institutions often drive price below these wicks to trigger those orders, creating sell liquidity to fill their own buy positions. If you see multiple wicks, the risk of a liquidity sweep is too high. A single trigger shows buyer intent. A cluster shows a trap, where you're likely to be stopped out before the real move happens. The most common mistake is entering a trade while the trigger candle is still jumping up and down, before the time period has actually ended. Step 3 is the confirmation close. Left, an early entry fails when the candle collapses before time is up. Right, the candle firmly locks in its closing price. To validate the move, this close must sit higher than the previous trigger's highest point. This close provides the evidence needed to separate a temporary bounce from a genuine shift in market direction. Step 4 is setting the precise entry now that the reversal has been validated. Instead of chasing the top, measure the large trigger candle's body. Mark a limit order at exactly the halfway point, the 50% retest. Price frequently pulls back to test the middle of a high momentum candle, allowing you to enter at a much better price. By waiting for this 50% pullback, you significantly reduce the distance to your stop loss, which maximizes your potential profit relative to your risk. Here is the full sequence. Red candles shrink as momentum dies. A hammer signals buyer influx. The next candle closes above to confirm, and price returns to the 50% line before the expansion. Skipping a step turns this setup into a gamble. A professional trader waits like a sniper. You only pull the trigger when every dial is tuned and the target is in perfect clarity. Every candlestick on your screen provides specific data about who is winning the battle between buyers and sellers. Use this checklist to ensure you only trade when that data is in your favor.